Welcome back to Economic Insights. I'm Alex, your host, and joining me in this episode is Selim, market veteran and the producer of this show. Selim, quite a week. Davos drama, Japanese bonds going haywire, and precious metals hitting levels nobody saw coming. Not me, at least.
We went from potential transatlantic trade war over Greenland to handshakes at the World Economic Forum, watched Japan's bond market stage what can only be described as its own Liz Truss moment, and saw silver break through $100 an ounce for the first time in history.
Let's start with Greenland. This was the main focus at Davos and dominated market attention. What happened?
Early in the week, President Trump issued an ultimatum on social media regarding the purchase of Greenland. He threatened 8 European countries with a 10% tariff starting February 1st, rising to 25% in June, unless a deal was reached for what he called the complete and total purchase of Greenland.
That's quite the opening.
The administration justified it on national security grounds. Trump initially didn't rule out using force, which naturally sent European leaders into overdrive. EU lawmakers threatened to halt approval of a US trade deal, and French President Macron wanted to activate the EU's anti-coercion instrument to retaliate.
How did markets react to all this?
Global equities sold off early in the week on the tariff threats. But then midweek, everything shifted dramatically following a meeting between Trump and NATO Secretary General Mark Rutte at Davos. Trump announced a framework for a deal, withdrew the tariff threat, and took force off the table.
So, what's actually in this framework?
The agreement shifted from purchasing sovereignty to a defense pact. It focuses on expanding the 1951 Defense Agreement to give the US total military access, including installing a Golden Dome missile defense shield. The framework includes provisions on mineral rights, but Denmark keeps sovereignty. US activity is limited to specific military bases rather than a total takeover.
And the market response?
Broad relief rally mid to late week. The S&P 500 erased its earlier losses and moved back within range of record highs. Crisis averted.
Now, you mentioned Japan having its own Liz Truss moment. That's not a comparison anyone wants.
No, it's not. The Japanese bond market experienced historic volatility, driven by fiscal anxiety ahead of their snap election. Japanese bonds suffered a massive sell-off. 10-year and 20-year yields hit levels not seen since 1999. The real drama was at the long end. The 30-year yield jumped 26 basis points in a single day, the largest daily increase since the maturity was introduced in 1999. 40-year yields crossed 4% for the first time since 2007.
That's dramatic.
The rout was fueled by election fever and fiscal populism. Prime Minister Takaichi and opposition parties started pledging temporary or permanent cuts to the consumption tax on food. A soft auction of 20-year bonds spooked investors further.
How did it stabilize?
Late in the week, Finance Minister Katayama verbally intervened, calling for calm, and a big financial lender announced plans to potentially double their JGB holdings to 20 trillion yen, signaling institutional support. The Bank of Japan also maintained its policy rate at 0.75%, though it was a hawkish hold. The vote was 8-1, with board member Takata dissenting in favor of a hike. They raised inflation forecasts for fiscal 2025 and 2026, leading to yield curve flattening as short-term yields rose while long-term yields retreated from their highs.
What else moved in markets?
Late in the week, Intel shares sank 17% following a weak outlook and manufacturing struggles, while Nvidia gained 1.5% on news about AI chip orders from China. But the real story was in commodities. Gold and silver prices surged throughout the week, reaching all-time highs by week's end.
Let's dig into developed markets. The US data looked exceptionally strong.
It did. Late in the week, third quarter GDP was revised upward to an annualized 4.4%. The expansion was primarily driven by strong consumer spending, which rose 3.5% quarter-on-quarter seasonally adjusted annual rate, and a narrowing trade deficit. Service-producing industries, particularly finance, insurance, and information, were significant contributors.
Is there any catch to these numbers?
There is a notable divergence between expenditure side and income side estimates. Gross domestic income grew at only 2.4% in Q3, 2 percentage points slower than GDP, suggesting output gains may be somewhat exaggerated. But the momentum is real. Real consumer spending increased 0.3% month on month in both October and November.
Are Americans saving as much as they spend?
No, and that's concerning. Disposable personal income rise is lagging behind spending. The personal saving rate fell to 3.5%, but some analysts suggest this low rate may be revised upward as measurement issues from the government shutdown get resolved.
And inflation?
Core PCE inflation has been holding steady at approximately 2.8% year on year through October and November. Tariffs contributed an estimated 62 basis points to the inflation rate through December. There's distortion in the data from the government shutdown, which likely dampened reported price increases.
What's the Fed likely to do?
Analysts expect them to pause at the January meeting. Labor market stabilization justifies a pause, but an easing bias remains. Projections include two additional 25 basis point cuts in June and December 2026.
What about Treasury yields?
Global bond yields rose, led by Japanese government bonds. US Treasury yields also increased, but some analysts still view 10-year yields as too low relative to fundamentals, and the 30-year yield is nearing 5%. Interestingly, foreign demand for US debt remains stable, net buying showing no significant impact from geopolitical events.
Moving to Europe, what's happening there?
Recent high-frequency indicators suggest resilient momentum. For full year 2026, analysts forecast euro area growth of 1.4%, up from 1.2% in 2025. Growth is expected to be supported by a robust global economy, resilient consumer spending, as income outpaces inflation, and expansionary fiscal policies, particularly in Germany.
And how about the inflation in the Eurozone?
Headline inflation is projected to dip below the 2% target in early 2026, driven largely by negative base effects from energy prices. Core inflation is expected to slow throughout 2026, potentially ending the year slightly below target at 1.8% as wage growth normalizes.
What will the ECB do?
The ECB is generally expected to keep interest rates on hold at 2% for the majority of 2026. They are in a good place.
Anything to mention in the UK?
Gilt yields have underperformed US and euro rates. Political noise regarding potential leadership challenges has increased. Inflation is expected to return to target in 2026, aided by unwinding base effects and cuts to household energy bills. The central bank is expected to cut rates 3 times in 2026, March, June, and September, bringing the terminal rate to 3%, below current market pricing.
Back to Japan. Beyond the bond market chaos, what else is happening?
Prime Minister Takaichi dissolved the lower house for a snap election on February 8th, aiming to capitalize on personal approval ratings of approximately 70%. And this is why the situation is so different to Liz Truss and the lettuce.
What about the fiscal policy after elections?
Regardless of the election outcome, fiscal policy is expected to loosen further. Both the ruling Liberal Democratic Party and the opposition have pledged consumption tax cuts. There are significant market concerns about funding. Markets are skeptical about long-term fiscal discipline.
Let's talk currencies and commodities. Gold and silver absolutely dominated headlines this week.
They did. Gold rallied to all-time highs, surpassing $4,900 per ounce and approaching the $5,000 milestone. Goldman Sachs raised its year-end 2026 forecast to $5,400 per ounce, citing intensifying demand from private investors and central banks.
And silver? I saw it broke through $100 for the first time.
Silver was the real story. It broke through $100 per ounce for the first time, jumping 5% in a single trading session. The futures market flipped into backwardation. Near-term delivery contracts became more expensive than deferred ones, indicating an acute lack of immediate supply.
What caused this?
Multiple factors. First, geopolitical hedging around the Greenland crisis. triggered massive risk-off capital flight into safe havens. But the bigger structural issue is China. They fundamentally altered global supply dynamics by reclassifying silver as a strategic national asset and implementing strict export controls requiring government licenses. This cut off refined silver exports, fragmenting the market into regional silos and preventing Western hubs from refilling their vaults. They're prioritizing domestic silver retention for their solar, electric vehicle, and high tech industries.
Are central banks involved?
There is speculation that central banks, including Russia and India, have begun accumulating silver as a strategic reserve asset, treating it as a monetary metal rather than just an industrial commodity. This is part of a broader de-dollarization trend, where emerging markets seek assets resistant to Western financial sanctions.
What about other commodities?
Oil prices remain trading modestly above fair value. Russian crude exports dropped sharply due to severe weather, alongside reduced refinery runs from drone attacks. Global supply was further constrained by a power-related shutdown at Kazakhstan's Tengiz field and a drop in Venezuelan output. But demand indicators remain weak. Copper remains in a holding pattern around $13,000 per metric ton, despite weakening fundamentals. There are aggressive counter-seasonal inventory builds in China, and the LME curve shifted from backwardation to contango.
Major currency moves?
The yen faced depreciation pressure due to fiscal risks, but recently staged a sharp rally following reports that the Federal Reserve Bank of New York conducted rate checks, fueling speculation of potential joint intervention by US and Japanese authorities. Strategists target euro-dollar at 1.20 by end 2026. A strong US economy provides support, but political pressure acts as a cap.
Let's turn to emerging markets. China first. How are things there?
China's showing what analysts call a two-speed economy. Real GDP growth slowed to 4.5% year-on-year in the fourth quarter, though they achieved the full-year target of 5%. Strong net exports and industrial production contrast with prolonged weakness in domestic demand and consumption. December data showed industrial production accelerating, supported by high-tech manufacturing and exports, while retail sales slowed and fixed asset investment contracted by 3.8% for the full year.
The property sector has been a drag on the consumer sentiment.
It continues to deteriorate with double-digit declines in sales, investment, and new starts, alongside falling home prices across major cities. Policymakers are expected to maintain a supportive stance in 2026 to revive domestic demand. The population decline also accelerated in 2025, with new births dropping further, long-term structural headwinds.
Turkey, what's happening there?
The Central Bank of Turkey delivered a hawkish surprise, cutting the policy rate by only 100 basis points to 37% versus consensus expectations of a larger cut. Financial institutions interpret this cautious decision as anchoring inflation expectations amid rising food prices and minimum wage increases, projecting a year-end 2026 rate of 30%. Demand continues to support disinflation, but retail loan growth has accelerated in real terms, leading experts to anticipate further macroprudential tightening. This adds much-needed credibility to the central bank. Fitch Ratings seems to have acknowledged this and upgraded Turkey's outlook to positive, while Moody's maintained a stable Ba3 rating.
South Africa?
Expectations for the upcoming SARB meeting are split. Some analysts forecast a 25 basis point cut due to headline inflation dropping to 3.6% and a strengthening rand. Others forecast a prudent hold to assess the cumulative impact of prior cuts and address fiscal credibility gaps. While headline metrics are positive, underlying risks remain: rising services inflation and a spike in meat prices due to supply chain disruptions. Government bonds look constructive due to a steep yield curve and high real yields.
Egypt still a favorite?
Just keep at it.
Shall we touch on some of the other emerging markets?
The GCC remains highly sensitive to oil prices and geopolitical tensions, particularly concerning Iran. With the arrival of US warships in the region, the possibility of further escalation increased dramatically. Current account surpluses are expected to persist under base case oil scenarios. Briefly on Asia, South Korea's economy contracted in Q4, missing expectations due to weaker construction investment and a pullback in private consumption. There's a sharp divergence between a booming semiconductor sector and sluggish performance in non tech sectors. The administration has begun discussing a supplementary budget unusually early, likely in the range of 10 to 15 trillion won, funded by higher than forecast corporate tax revenues rather than additional debt. Indonesia's central bank maintained its policy rate at 4.75%, pausing its easing cycle to prioritize stabilizing the rupiah, which has faced depreciation pressure from foreign outflows and corporate demand for US dollars. Investor sentiment has been weighed down by a fiscal deficit nearing the 3% legal limit and concerns about central bank independence following the nomination of the president's nephew for a deputy governor position.
Looking ahead to next week, what should we be watching?
The Federal Reserve meets Wednesday and is widely expected to keep rates on hold. The statement is anticipated to upgrade the growth assessment to a solid pace and describe the labor market as sanguine but stable. Chair Powell's press conference focus will likely shift to non-economic issues, specifically the recent Department of Justice subpoena regarding renovations to Fed buildings. Expect him to defend Fed independence vigorously. The Bank of Canada also meets Wednesday and is expected to hold at 2.25%, signaling the end of their easing cycle after 100 basis points of cuts in 2025. Brazil is expected to hold at 15%. South Africa is likely to cut 25 basis points.
Tell us the key data releases to look out for.
For the US, durable goods on Monday, consumer confidence Tuesday, producer prices Friday. Europe gets preliminary Q4 GDP Friday. January inflation figures also drop Friday, with German inflation expected at 1.93% year on year. Japan has a busy Thursday with Tokyo CPI, retail sales, and industrial production. Australia's Q4 CPI. Wednesday is key. Trimmed mean expected to stay elevated at 3.2% year on year, testing the RBA's tolerance.
Commodities and geopolitics to watch?
Watch oil prices and precious metals for any escalation with Iran. Japan's lower house election campaign officially begins January 27th. Expect more fiscal promises and potential bond market volatility.
It's a big week for corporate earnings.
Massive week for tech. Microsoft, Meta, and Tesla report Wednesday, Apple Thursday. Those four alone comprise 16% of S&P 500 market cap. Semiconductor results from ASML, Samsung, SK Hynix, KLA, and Lam Research provide insight into the AI hardware cycle.
Selim, thanks as always. Quite a week and an even busier one ahead.
Indeed. Stay sharp out there.
Don't forget, folks, we do not give investment advice. For that, please consult a professional. Thanks for listening to Economic Insights, and we'll see you next week.